Are we going to sell the investment because there's a sudden sell-off caused by inflated valuations and profit taking? Hi, this is Janice. For this week's Unemotional Money series, I'll be sharing with you 3 guiding principles I personally use to sell my investments. If you're an investor, you might have wondered about this question before. My investments are currently going up. When do I let go of them? Here are the 3 key principles I use to sell my investments. Number 1, when the investment philosophy is no longer relevant. We all make investment decisions based on certain reasons. It might be because we decide to invest in a company or a sector because it is undervalued. It might be because of our belief that investing in this particular sector has certain advantages. Are we going to sell the investment because there's a sudden sell-off caused by inflated valuations and profit taking? As long as the original premise I decided to invest stays true, I'll stick to my investment because markets move in zigzag. Corrections are bound to happen before prices move higher. If I sell my investments every time there is negative news and buy back my investments when market stabilizes, I'll be buying at higher and higher valuations. However, if the premise of my investments are no longer applicable, even if I'm losing money, I won't have emotional attachment to my purchase and simply cut losses and take it as a wrong hypothesis. The second principle I will sell my investment is when I need to spend money. Given that I invest most of my funds except my emergency funds, I need to liquidate some of my investments whenever I want to make big purchases. It can be for housing, for my down payment of my car, or simply because I want to go for a more expensive holiday. The idea of not liquidating the investments when I don't need it is because the returns on my investments are much higher than the interest I get in the bank. So it makes little sense if I liquidate my, for example, 10% per annum investment to let the money earn 0.05% in the bank. Obviously, money management makes a difference whether one has more or less money. If you liquidate your investments for every nitty-gritty purchase because you simply love spending more than you earn, you will likely not be better off investing. The third principle I will sell my investments is when I want to adjust my risk exposure. Sometimes I liquidate my investments when I wish to redirect my funds from higher risk instruments to lower risk instruments. Investing still has an element of uncertainty, and channeling them to principal guaranteed asset classes will help me to lock in some profit and lower my risk exposure. Of course, when I do this, I don't expect my returns I channel to safer asset classes to remain high. When I channel my funds into lower risk instruments, my objective is wealth preservation, which is simply to meet inflation and ensure my capital stays intact. At my age, my risk appetite is still pretty aggressive. However, I foresee that my risk tolerance will adjust as I take on more financial commitments and as my life stage change. These 3 selling principles have helped me to avoid selling my investments too soon and allow time for my investments to actualize the premise why I invested in them in the first place. That's all I have for you today. If you found what I shared useful, please hit the like and the share button so that more people can benefit from this information. See you next time.